Month, September. Year, 2024. Day, Tuesday. I hate to say I told you so, but I told you so. I was right. The bears were wrong. The bear thesis crumbled like a Cadbury flake because PayPal beat earnings.
Will shock the world.
Google beat earnings, AMD beat earnings, and what a time to be alive. The S&P 500 has gained 40% in the past 20 months in light of an election, geopolitical concerns, inflation, and the current macro environment. It's been a wild, wild year. But the question we always ask on this channel is, where do we go next? Well, today, I'm bringing you the data and stats on what comes next, because the next 7 days leading up to November 5th is going to be absolutely pivotal. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and tech stocks led a mixed day for the markets on Tuesday as investors digested new data on jobs openings and absorbed a fresh wave of earnings. Tech outperformed, semis outperformed. Google and Meta were up both in excess of 1.5%. Amazon was up 1%, but Apple flat on the day. Infrastructure gained. And then you look at the broader market from financials, healthcare, industrials, staples, energy. They were all red on the day. And yesterday, the broad market gained and tech stocks fell. And we just saw a bit of interplay where tech stocks now gained and the broader market. But the big thing that everybody was looking at today was Google's earnings. Shares of Alphabet moved around 5 to 6% higher in the after hours trading after the company beat third quarter earnings expectations on both the top line and bottom lines, and its cloud business continued to expand. Revenue accelerated for cloud. Revenue beat up 12% year over year to 88.27 billion. The market was actually expecting 86 billion, a huge beat in revenue. Adjusted earnings came in at $2.12. The market was expecting $1.83. Cloud revenue came in at 11.35 billion, and we saw 35% year-over-year growth and a re-acceleration on a sequential and year-over-year basis. Ad revenue came in at 65.85 billion. The market was expecting 65.5. Just an overall great day, great earnings setup for Google, and this will probably go to the 200 mark in the next 6 to 12 months if Google continue this momentum in their earnings. We did get a huge semiconductor report earnings, AMD, and the stock dropped about 6% after its guidance came in softer than expected. Overall, the stock was sitting at about 3% for the day, and this entire drop was based on its guidance figures. Its market expected guidance to come in at about 7.6 billion. It came in at 7.2 billion, and the market did not like that. However, revenue did top estimates this quarter, and adjusted earnings per share met expectations at about 92 cents. So earnings were solid, guidance a bit iffy. All in all, I would say a very solid quarter for AMD, but a lot left to be desired in the future. Very similar to PayPal. PayPal was down about 5% today, and they actually beat on an adjusted earnings per share basis. They reported $1.20. Street was expecting $1.07. Revenue missed. However, honestly, I didn't really like these earnings. It was very, very mixed. Revenue missed, but margins expanded. Unbranded growth was slowing. That was part of the big driver as to why I bought PayPal, but their TPV looks really, really strong. Their elevated marketing spend is eating into their GAAP earnings because they returned so much to shareholders. They did $1.8 billion in buybacks this quarter. Their GAAP EPS numbers came in at 99 cents. Now, here's the crazy thing. This included a one-time impact of 14 cents from their PayPal Venture division of unrealized losses on that number. So the actual GAAP numbers came in at $1.13, which is very, very strong if you exclude that unrealized loss, which is ridiculous to me, right? But the gist of this earnings was management is sacrificing revenue for margins by prioritizing profitable growth through their price to value strategy. And they also did give a guidance raise. They raised non-GAAP EPS guidance to high teens growth, but a lot left to be desired with GAAP numbers, which is seeing mid to single digit earnings growth through the end of the year. Very mixed quarter. I still hold. I don't know what I'm going to do with the position, but I'll have to re-listen to that earnings call. But when we dive into the earnings for the broader market, we tend to see very solid results. Visa had solid results. McDonald's had solid results. Pfizer, exceptional results. And this was because they smashed revenue. The actual revenue came in at 17.7 billion. The market was forecasting 14.9 billion. Huge. We saw outperformance here in earnings for Chipotle, but revenue came in a bit mixed. All in all, though, earnings was good, revenue was good, and today's market momentum and action really just stemmed off buyers and sellers taking profits and positioning ahead of earnings, guys. We saw tech and communication services outperform today. Tech gained 1.35%, communications nearly gained 1%, but every other sector fell, and that weighed on the overall market, with the worst performing sectors being energy and utilities down 1.52 and 2.14% respectively. And the sell side action led itself into mid caps and small caps. Not so much the growth segment. Growth was actually fine across the board, but core value in smalls and mids and value in large caps saw very, very ugly price action, and the real winners was just large cap growth as well as mid cap and small cap growth, but large cap growth really the big outperformers here today. We're looking at Google, Meta, Nvidia, semis. These names outperformed, and that's what really held up the market today. But this is also coming off a day when large caps yesterday underperformed and mids and small caps outperformed. What also weighed on sentiment today was actually data we got from the Bureau of Labor Statistics. Job openings came in. The actual number was 7.4 million. The consensus was 7.9, so we did miss. We also saw August jobs figures got revised lower. The previous number was 8 million. The revision came in at 7.86 million. So that weighed on sentiment overall, but it wasn't all bad news because yes, job openings did fall, but hires did increase. And so there was that interplay that the market was contending with. Globally, markets came in very, very mixed. We saw the US gain on the back of the mega caps, and it was pretty much red everywhere else. Excluding India and Australia, we saw red in most of Asia, most of Europe, as well as most of South America. And maybe that's part of taking profits, a little bit of a give back on yesterday's bullish momentum, maybe part of the Trump trade. Globally, Trump is more domestic focused, and globally that could hinder international trade, especially with all the tariffs he's talking about. But despite everything we saw today, when we look at the bigger picture, shorter term averages remain intact, medium term averages remain intact, longer term averages remain intact. And that means you do want to stay long this market. Yes, we did see a little bit of a deterioration yesterday, but such goes the market. We do get this interplay between buyers and sellers, but as long as these averages are intact, you want to remain long. And I don't see anything taking us off course right now because earnings is coming in very, very solid, and the macro looks pretty good as well. But looking at the charts, guys, we saw a lot of interplay between indices, sectors, and market moving dynamics. So we saw yields. This is the after hours price, but yields actually fell today, and hopefully we do see a continuation of this. Yields fell across the curve, the 2-year, 10-year, and 30-year yield, and the dollar remained flat. And that's why we actually saw a support and bid for stocks, especially with stuff like the RTY. If we actually just zoom in, you can see this huge wick here. Yes, we did print a red day, down 0.32% in the Russell 2000, but look at this wick, right? We went into negative gamma, back into positive gamma on a very strong wick, meaning buyers did come in, and we're sort of holding these lows right here, meaning that this higher low that we're making right now is still in play. Very solid price action despite the headline figure down 0.32%. If we actually just go to the daily chart, we can see very, very strong buying action here in the RTY. We saw, yes, we did get into negative gamma. However, buyers came in a very strong way, and we're back in positive gamma right now. And again, that had to do with just the interplay from yields. If we actually just go to the daily chart, you can see if we zoom in here to the 10-year yield, another huge wick, which means even though yields were down 0.64% from their highs, they were down a lot more. And that sort of put a bid under these smaller cap names. The dollar also came in a bit, and we did see bonds gain ever so slightly. Commodities were the real outperformer today. If you were diversified into commodities, you did very, very well. Gold up 1.18%, Bitcoin nearly up above 3%, silver 2.3%, crude virtually flat considering the volatility in that commodity. And then looking at equities, the S&P 500 gained 1.6%, Nasdaq 100 nearly a full percentage point. Really goes to show how strong everything's looking there. But when we look at the after hours price, QQQ, that's a very liquid asset, even in the after hours, up 0.25%. So Google and Visa and some of those bigger names really lifting the Qs. The SPY is also up 0.19%. The RSP down in the after hours. Although this ticker is illiquid in the after hours, mid caps in aggregate actually did gain ever so slightly. And then the S&P 600 down 0.41%. So a very mixed day in equities, slightly upbeat, but I think the earnings today should support price action tomorrow and for the rest of the week, especially if the mega caps report exactly the way Google has and Tesla has. So far, the mega caps have really done very well this earnings season. season. Looking at the S&P 500, guys, we continue to just trade from the upper band of this range, not really doing much of anything, which means as a bull, you want to buy dips, sell rips. And if we get to the 57.75 area, that's the place to buy. Aim for the 5900 level. I think we are seeing sideways momentum, and we'll continue to see that into the election. After the election, the market will be free to do whatever it needs to do. Looking at the Nasdaq 100, we're sort of approaching the upper end of this zone. We did see the put support move up yesterday, but we're getting eerily close to these all-time highs. I think one good print from Meta or Apple this week, and we'll take out these highs and hit new all-time highs in the Nasdaq 100. A very constructive day. And then looking at the RTY in positive gamma, a lot of volatility at this gamma flip zone. However, we are in positive gamma. That means you buy dips, sell rips, and we're aiming for the 2300 level. And despite all of the price action we're seeing, I think small caps are holding up really, really well, all things considered. Guys, looking at gold, that's another new all-time high. That's a strong close, guys. I said this plenty of times. I think we're going to see 3,000 gold, $3,000 per ounce in gold sometime in the first or second quarter 2025. And we could definitely see $40 in the same time period for silver. I'm very bullish on silver, very bullish on gold. And it's just a reflation trade that we're seeing, especially if we do get a Trump victory. So I do think you do want to have commodities in your portfolio, especially in a rate cutting cycle. They tend to do very, very well when rates are cut. But all in all, guys, I think equities continue to look very, very strong. I think earnings look strong, and the after hours is telling us exactly what we need. And that stocks are probably going to go high into this week. And if Google's earnings are anything to go by, the rest of the mega caps are going to perform really, really well this earnings season. So any dips we do get, guys, buy those dips. Don't trip. And guys, let's talk a little bit about earnings. We are in the thick of earnings season. This right here is S&P 500 earnings above, in line, or below its estimates coming into Q3. And if we actually have a look at the S&P 500, 75% of companies so far have reported above analyst expectations. Very robust. 80% in line, meaning that 80% of S&P 500 companies have reported in line or above analyst expectation. Now that does leave us with 20% reporting below. However, when you look at it on a market cap basis, look at stuff like utilities, 100% above expectations, infotech 94, staples 86, healthcare 84%, financials, comm services 83 and 82%. These are the heavy hitters in the S&P 500, and they are reporting in line or above analyst expectations in excess of 80%, and that's exactly what you want to see. The overall market is being weighed down by stuff like materials, real estate, and industrials. All in aggregate, earnings looking very, very robust. And the same is true for revenue figures. Oftentimes, revenue does undershoot. It's a lot harder to beat on the revenue side, but we see much of the same dynamic. 59% reporting above revenue expectations, however, 41 reporting below. But then when we actually look at it, again, healthcare, infotech, financials, all reporting in excess of 70% above analyst expectations. That's exactly what you want to see coming into earnings season. And that's why having subpar expectations into an earnings season could lead to huge beats. And that's why we are seeing very robust earnings in this third quarter earnings season. And something else we're seeing is margins. Now, margins this earnings season was expected to be about 11.8%. So far, we're reporting 12%. And this represents the second quarter in a row of 12% or higher. This is very similar to the margin profile we saw here in 2021 when we went on the everything rally, stimulus money. And do expect this to continue. Next 12-month forward-looking margin estimates are very closer to 13.5%, closer to 14% around there. So there is room for margins to expand. And guys, when you see robust earnings beats like we have right here, followed with an execution on the margin side, stocks move higher. And I say it so often, when earnings are growing, margins are expanding, stocks tend to go higher, especially in the longer term. That's exactly what investors want to see. Now let's dive into seasonality over the next 3 months. This is S&P 500 performance from October 27th to January 27th. In the last 50 years, when the trailing 12 months was greater than 10%, the S&P 500 has rallied about 30% in the last 12 months, and we see very robust returns. The full period average return, that's literally just 3 months, guys, 5.65%. Average return, 7.23. Median same return, 23 wins, 4 losses, and we see very linear returns in November, December, and January. So if we do get dips, buy those dips because the path of least resistance is up. This is the S&P 500 composite cycle versus the actual price action we've seen in 2024. This dark blue line is the composite cycle, and we are at the inflection point where we actually see a rally up according to this composite cycle, then a bit of consolidation into the November-December time period, and then the last little bit we do see a rally to the upside. And this composite cycle consists of every year ending in a 4 since 1954, every election year, and every year between 1950 to 2023. A very robust composite cycle, and we should see huge upward momentum. Now, we might not see this type of move, but we may see something very, very similar, and that's just general upward momentum into the end of the year. And the truth is, guys, you don't really want to fight the trend because seasonality is not some magical, mystical thing. There's actual market dynamics behind it. You see, over the next 3 quarters, we actually have shortened trading weeks because of Christmas, Thanksgiving, etc. This increases average daily liquidity. We also have buybacks. Q4 buybacks are typically the highest in the year, and with shortened trading days, that just boosts demand overall. We also have the December OPEX, which is the largest OPEX of the year, driving volatility, especially in bullish years. We see upside volatility because we have a lot of leaps contracts expiring, and money managers also need to reinvest in the shortened trading period to collateralize their investments for the new years. And also holiday spending creates anticipation for a great Q4 and sometimes Q3 earnings season. And when it all comes together, it results in an end of year rally to yearly highs, which happens about 83% of the time. So you want to hold equities, you want to remain long because historically speaking, seasonally speaking, things are poised to go higher across all indices. This is not just the S&P 500. This is across all markets in the US and even globally. We also have a bunch of tailwinds to contend with the equity markets. This is the copper and gold ratio versus the 10-year yield. The copper to gold ratio is often a leading indicator for the direction of US 10-year yields, and we've seen a divergence as of late. And this means that we should see a pullback in yields to follow the overall trend. And that's part of the reason why I'm very, very optimistic on yields going lower into the end of the year. Now, I'm not expecting us to go back to 3.5% in the 10-year, but I think 20, 30, or 40 basis points lower from where we are now seems reasonable. Another tailwind we have is buybacks. Companies have the scope to add $6 billion in share buybacks after this blackout window, which ends anywhere between now and the end of the week for the majority of companies. And in total, this would represent 21% of total annual buyback executions. And just for the record, between now and December, there's only 35 trading days. So about 21% of annual buybacks executions, which represent about 13 to 14% of total trading days in the year. That's very, very bullish and just a complete tailwind for equities. These are literally corporations buying their stock. It literally puts a floor underneath these stocks. And something else we're seeing is the equal weight and S&P 500 and how they normally diverge. Now, historically, if the S&P 500 equal weight fails to confirm a new all-time high within 90 days of a new S&P 500 high, the market normally turns lower, which is this purple line right here. However, if the equal weight makes a new all-time high 90 days after the S&P 500 makes a high, we normally see new highs 3 months thereafter. And luckily for us, the equal weight and S&P 500 have made new all-time highs within 90 days of each other. Just another tailwind into the end of the year. And this is a tailwind for the broader market. So guys, hold equities. You want to stay long because seasonally things look very, very bullish from here. And also the macro environment is quite robust. Now, yesterday I showed you the Fed's GDP now sitting at 3.2%. And historically, that would suggest an NFP print of 240,000. But Goldman don't see it the same. Goldman actually see NFP coming in at 95,000. The consensus is 110K. According to the data set I just showed you, we're expecting about 240K. So there's a huge range there. But here's the thing. If we have a strong, robust NFP, that's going to be good for stocks. But if we have a weaker NFP, that's also going to be good for stocks because it bodes well for the inflation picture. However, Goldman Sachs don't see deterioration in the employment market. They see the unemployment rate staying steady at 4.1%. They see ISM manufacturing coming in at 48. They also see 115K in ADP private payrolls, 3% US real GDP for the GDP print, and they see 2.03% in core PCE this week. And all in all, they see a robust macro environment, except a little bit of a tamer number in non-farms. Maybe that has to do with some of the strikes we've seen, as well as the hurricanes. But if we look at the data right here, this suggests something different. And I think the truth is going to be somewhere in the middle, but we'll see how things pan out from here. Looking at earnings, guys, huge week, and we are in the thick of it. Tomorrow, before the open, we have Eli Lilly, Caterpillar, Humana, Global Payments, ADP as well. So for those of us that hold Paycom software, this is going to be a huge driver of sentiment. And then after the close, we have Microsoft, Meta, Coinbase, Robinhood, Etsy, Riot, Carvana, Starbucks. Guys, a huge day of earnings tomorrow. And we also kick off the big data prints. We get the GDP growth rate. The consensus is 3%. Trading economics forecast 3.3%. JOLTS opening, we're looking at 7.8 million. That's going to be a huge deterioration from the previous number. So those are the big prints tomorrow, JOLTS and the GDP. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.